Welcome back to Accounting 5000, where we're going to be beginning Module 17, Chapter 8. We're going to finish up Chapter 8 and talk a little bit about stock dividends, cash dividends, treasury stock, and a few other items that are going to be showing up at the end of the owner's equity section. So let's start out by talking a little bit about stock dividends. Oftentimes a firm wants to give a return to their investors, the ones who have given them some money and they have given them stock in exchange, but they don't really have any cash to give them back as a return. So instead of declaring a cash dividend, they will declare a stock dividend. In this case, they're going to give their investors additional shares of stock. It comes out of retained earnings the same way a cash dividend does. It reduces retained earnings. It uses your common stock account and your additional paid-in capital accounts in addition to your retained earnings account, in that it reduces retained earnings, it increases the common stock that is outstanding, and it increases additional paid-in capital. Typically you make this entry based on the market price if it's a small stock dividend. If it's a large stock dividend, you do it based on par value. We're not going to get into all the details of that, but most companies give small stock dividends in which they use the market price of a share of stock to make an entry. This is another way that a firm can use to do what we call capitalizing retained earnings. They can move funds from retained earnings, which are available for dividends, and put them into capital stock, thereby leaving less money available in retained earnings and moving some into capital stock to show more equity. Remember, we're going to use our debt-equity ratio often for trying to receive loans. This increases our equity. You also have a thing similar to a stock dividend in a stock split. A stock split occurs when a firm has stock that's outstanding with a par value of, let's just say, $2, and it decides that they're going to do a stock split. For every share of stock that a stockholder has now, they're going to have 2 shares of stock. So they're going to have twice as many shares of stock out there. But in return, they're going to cut the par value in half so that the common stock amount will stay the same. There'll just be twice as many shares for half the amount. If they do a 3-for-1 stock split, they will have 3 times as many shares of stock, but a third of the par value of the stock. This is a maneuver a lot of firms use when their stock price gets too high. Remember, investors go out and buy stock in lots of 100 shares. So if the price of a share of stock gets too high, that's going to eliminate a lot of investors from purchasing that stock. In order to bring more investors into their market, firms will cut the price of their share of stock by issuing a stock split, thereby reducing the purchase value of the stock and inviting more investors in to purchase the stock. It lowers, again, the par value and increases the number of shares, but it does not affect the total amount that's shown besides the common stock account. In this entry, we do not actually make numbers in a financial statement entry. We only make what we call a memo entry. We write a note to ourselves that says we did a 2-for-1 stock split. The par value is now half of what it was, and we now have twice as many shares. So there is no real accounting entry that's made, just a memo entry to ourselves. The third topic in this chapter deals with treasury stock. And remember, a minute ago in the previous module we talked about the fact that a company can issue shares of stock and then buy them back. And when they bought those shares back, they were called treasury stock. You repurchase your own stock that's already been sold. Lots of times firms will do this to keep other people from buying their stock. If the other people can't buy their stock, then they can't take over the company. So it does what we call defeat a takeover. It reduces the chances that a firm will be taken over by an outsider. A firm can also do it to increase the price of their stock. If you think about your economic idea that supply and demand, the lower supply, the higher the price, the demand goes up, the price goes up. If there are fewer shares of stock out there to be purchased, then the price of the stock should go up. So lots of firms will buy back some of their outstanding shares simply to increase the stock price selling point. A third time that companies will buy back their own stock is when they have employee stock purchase plans. In this case, lots of firms give their employees the incentive to buy stock in the firm. They want the employees to be a part of that firm, so they encourage them to buy stock. But they do it through a plan that the firm has, so the firm has to buy the stock back in order to sell it to their employees. So that would be treasury stock that they would turn around and eventually resell to their employees. One of the things that you need to remember about treasury stock is that it is not an asset. When you purchase it, you debit treasury stock and you credit cash, but the debit to treasury stock is not an increase in an asset. It is actually a decrease in owner's equity, negative owner's equity. So if you look at a balance sheet, on the owner's equity side, you'll see a very bottom line, typically under owner's equity, is treasury stock, and that will be a negative amount. It's a reduction in owner's equity. So be aware of that when you're looking at treasury stock. It's not an asset. It's a negative owner's equity account. If you turn around and sell treasury stock, you may actually sell it for more than you purchased it for. You can't have a gain in that case. You can't make money or gains on sales of your own stock. So what you have to do is increase your additional paid-in capital account, or your PIC account. If you sell it for less than you bought it for, it reduces your additional paid-in capital account. So any difference between what you sell this treasury stock for and what you paid for the treasury stock affects additional paid-in capital. Another thing you will notice from our previous modules is that we did not pay dividends on treasury stock. That would be like paying yourself, because you own the stock, so there would be no reason for you to pay yourself dividends. So you only pay dividends on those shares of stock that are still out there. A couple other things that you will see in the owner's equity section of a balance sheet is called other comprehensive income. This is a fairly recent addition to the balance sheet, and it includes not only your net income that you usually see, but it includes three other things: cumulative foreign currency translation adjustments, unrealized gains or losses on your available for sale investments, and your minimum pension liability adjustments. Now those are pretty complicated matters, but what it results in is that other comprehensive income account includes lots of things that don't really belong in net income because they are one-time events or events that management can't control. So they take those unrealized gains or losses because they haven't been realized, they haven't sold the stock yet, and they put them in other comprehensive income. They take pension adjustments and put them in there because management can't really control that. And management can't control the changes in the exchange rates of foreign currency. A lot of firms do business overseas, so they have to do the business overseas in a different denomination. Rather than dollars, they do it in marks or yens or pesos. And the exchange rate for those things to the dollar changes over time. So we put those adjustments in other comprehensive income. So you may notice a title under your owner's equity section called Other Comprehensive Income, and currently there are 3 items that go into that account. There may in the future be other items added as the FASB addresses some very technical issues in accounting. You may remember when we first started talking about financial statements, we said there was a balance sheet, there was an income statement, there was a statement of cash flow. There's also a statement of changes in owner's equity. This can be a particular statement that's set apart all by itself on a separate sheet of paper in the financial statements, or it may just be the bottom part of the income statement. Lots of times it's shown right below the income statement. After you do earnings per share, there will be a little piece that includes the changes that occurred in owner's equity. Other times it will be what we call a standalone statement, in which there's a lot of detail given about the income that came into retained earnings and the changes in stock and the changes in treasury stock. But often it's just seen as a small piece. You can find it almost anywhere in the financial statements, but typically it'll be at the end of the income statement or on a separate piece of information. So let's take a few minutes then and review what we've learned by looking at the exercises at the end of this chapter. And let's start out by looking at exercise 16 in Chapter 8, Exercise 16, is on the very bottom of page 299, and it's continued to the top of page 300. It says, assume you own 200 shares of Blue Co. Inc. common stock. You currently receive cash dividends of 84 cents per share per year. If they declared a 5% stock dividend, how many shares of stock would you receive as a dividend? Well, you would receive 5% of the number of shares that you currently have. You currently own 200 shares of that stock, so if you got a 5% dividend on that, you would get 10 additional shares of stock. Part B is at the top of the next page. It says calculate the cash dividend per share amount to be paid after the stock dividend. That would result in the same amount of cash dividend. So they want the same total of cash to be paid out, but there are 5% more shares of stock on which to cover with that dividend, so it's going to be smaller than the 84 cents you had before. Since it was a 5% dividend, you're going to divide the 84 cents by 1.05. So you divide 84 by 1.05, you get 80 cents per share. Now if it had been a 10% stock dividend and you were doing the same problem, you would divide 84 cents by 1.10. So you just add 1 to the percentage amount and divide it into the current dividend to figure out what the new dividend would have to be to maintain the total amount of dividend for that particular year. In Part C it says if the cash dividend remained at 84 cents a share after the stock dividend, what per share cash dividend amount without the stock dividend would have accomplished the same cash dividend? Well, if you have 210 shares now because you got a 5% dividend and you got 84 cents a share, you would get a total of $176.40. In Part D it says, why would a company have a dividend policy of paying 10 cents per share cash dividend and issuing a 5% stock dividend every year? Well, this new dividend policy would result in giving out more cash dividends every year, but they wouldn't have to change the amount of per share dividend every year. Additionally, it would give them the chance to give investors an additional return besides the cash that they were going to receive each year. So it gives a double incentive. Let's talk next about treasury stock, and let's use exercise 21 as an example of treasury stock transactions. This is on page 301 of your textbook, about the middle of the page. On May the 4th, 2004, Docker Inc. purchased 800 shares of its own common stock in the market at a price of $18.25 per share. On September the 19th, 2004, they sold 600 of these shares at a price of $19.50. So they sold them for more than they purchased them. There are 36,200 shares of Docker common stock outstanding prior to the May 4th purchase of treasury stock, and a 35-cent per share cash dividend on the common stock was declared and paid June 15th of 2004. So what you need to be careful of in this problem is the amounts and the dates. So the first thing they ask you is to use the horizontal model or write the journal entry to show the effect of the purchase of the treasury stock. We're going to purchase treasury stock, so that's a decrease in owner's equity, so that would be a debit to treasury stock. We're going to purchase it, so we're going to pay cash, so we would reduce cash with a credit. 800 shares of stock times $18.25 per share would be $14,600. In Part B, we're going to declare and pay the cash dividend on June the 15th. Well, remember we had 36,200 shares before we bought back the stock, so we now have only outstanding 35,400 shares. We're giving each of those shares 35 cents, so we multiply 35 cents times 35,400 shares. We're going to have to pay out $12,390. Paid out means we're going to reduce cash. We reduce the asset of cash with a credit for $12,390. That cash dividend comes out of retained earnings, so it reduces retained earnings. Retained earnings is an owner's equity account, so to reduce it, you would debit retained earnings $12,390. Finally, you're going to sell the treasury stock on September the 19th. Remember, you're selling it for $19.50 a share, which is more than you paid for it. So let's figure out what we're selling it for. We're selling 600 shares for $19.50, so we're selling it for $11,700. That's how much cash we will receive. So to increase the asset of cash, we debit cash $11,700. Now we're giving up only 600 of our 800 shares of treasury stock, so we're giving it up at $18.25, which is what $18.25, which is what we paid for it. So $18.25 times 600 is $10,950 that we're getting rid of. So to reduce our treasury stock, we credit treasury stock for $10,950. Now earlier said we can't make a gain, can't have a loss either, on exchanges as treasury stock. Any difference between what we paid for it and what we sold it for has to go into additional paid-in capital. So the difference is $750. It needs to be a credit so that our journal entry will balance. So we credit additional paid-in capital, $750. So that problem took you through the purchase of treasury stock, paying a dividend, and selling treasury stock. Now let's flip over to problem 28, which is near the top of page 305 in your textbook. And let's do a little bit with dividends, stock splits, stock dividends, and other things related to owner's equity. What you have here is Bacon Inc., which has the following owner's equity section in its May 31st, 2004 comparative balance sheet. They give you down the left side the different columns that are under paid-in capital, common stock, preferred stock, retained earnings, treasury stock. Then they give you the totals for May of 2004 and April of 2004. They have two question marks in the May of 2004, which you're going to have to fill in. So in Part A, the first thing they ask you is to calculate the amount that should be shown on the balance sheet for common stock as of May 31st, 2004. Well, it says, if we look at our caption there, under common stock, that we now have 200,000 shares of common stock. Our common stock has a par value of $6. Both of those numbers are given in the caption there. So 200,000 times $6 would be $1,200,000. In Part B, it says the only transaction affecting additional paid-in capital during the month of May was the sale of that additional common stock. What price did you sell those stocks for? Well, the price that you sold the shares for would be equal to the total increase in common stock and additional paid-in capital divided by the number of shares of stock you sold. Well, you sold 10,000 shares of stock. You had a $60,000 increase in common stock and a $160,000 increase in additional paid-in capital. So dividing that total by 10,000 shares of stock, you sold them for $22 a share. In Part C, it asks you what was the average cost per share of common stock purchased for Treasury during the month. Well, notice you went from 8,500 shares of Treasury stock to 9,000 shares of Treasury stock, so you purchased 500 shares of Treasury stock. Your Treasury stock account went from $816 to $830, so it went up $14,000. So you simply take the increase of $14,000 and divide it by the number of shares, 500, that were purchased, and that gives you $28 a share as your average price. In letter D, it says that dividends on preferred stock equal to the half of the 2004 dividend requirement were declared and paid. There were no common dividends declared or paid in May. Calculate net income. Remember your equation for calculating retained earnings. You take your beginning retained earnings amount, you add net income, you subtract your dividends, and that will equal your ending retained earnings. Well, your beginning retained earnings was given to you in the problem by reading through that chart. It was $6,812. You don't know what your net income was. You know your dividends were $192,000 because you calculated that by taking your 8% preferred stock times the $120 par value and the 40,000 shares, and you pay it twice a year, so you take half of that. So your dividends were $192,000. You know that beginning retained earnings plus your net income minus your dividends is going to equal your ending retained earnings. You're given that amount as $6,950,000. So all you have to do is work through the math there and solve for net income. And net income results in being $330,000. Part E of the problem says assume that on June 1st the Board of Directors declares a cash dividend of 42 cents per share on the outstanding shares of common stock. The dividend will be paid on July 15th to shareholders of record on June 15th. Calculate the total amount of the dividend. We're going to pay 42 cents a share times each of the shares of outstanding common stock. Well, we have not been given the number of shares that are outstanding. We're told the number of shares that were issued was 200,000. We know of that 200,000, 9 of them are in treasury stock. So therefore the number of shares that are outstanding is the difference between 200,000 and 9,000. And we're going to give a 42 cent per share dividend on that number of shares of stock. So if you do the math there, you're going to give a dividend of $80,220. Part 2 asks you to explain the impact of this action on the June 30th balance sheet and the income statement. It will reduce retained earnings because dividends come out of retained earnings. It will increase your dividends payable because as soon as you declare the dividend, it becomes a liability. Your journal entry there was to debit retained earnings and credit dividends payable. It will have no effect on your income statement because dividends are not an expense. Letter F, it says assume that on June 1st the market value of the common stock is $36 per share and the Board of Directors declares a 3% stock dividend on the issued shares of common stock. Use the horizontal model or make a journal entry to show this transaction. Okay, if we have 200,000 shares of stock, we're going to issue a 3% stock dividend on that. 3% of 200,000 is 6,000 shares of stock. The 6,000 shares of stock has a $36 value, so that gives us $216,000 that we're going to take out of retained earnings. The common stock has a stated value of $6 per share, so 6,000 times $6 is $36,000 that we put in our common stock account. The remainder, the difference between the $36 and the $6, is the $30 that goes into our additional paid-in capital account for $180. In letter G, assume that instead of a stock dividend that was given in F, the Board of Directors decides to do a 3-for-1 stock split when the market price is $36 a share. What is the par value and how many shares of stock will there be after the split? Well, if it's a 3-for-1, you divide your par value by 3. Your par value is 6, so divided by 3, that's 2. If you're doing a 3-for-1 stock split, then your stated value is 1/3, but the number of shares is 3 times as great. So you would multiply that by 3. So 9,000 times 3 would be $27,000. What will be the market price per share of common stock after the split? There would probably not be any change. There may be a slight change in the future, but it typically will not go up very much. How many shares of common stock will be in the treasury after the split? You have 9,000 in there now. You're going to give a 3-for-1. You give a stock split on your treasury stock, so there will be 27,000. How much will total shareholders' equity change as a result of a stock dividend? In Part F, there won't be any change because your retained earnings will go down the same amount that your common stock goes up. And the stock split, remember we don't make a journal entry for a stock split. We simply do a memo entry on that. So again, there's no change. So in this module, what we've talked about is stock splits, stock dividends, what happens with treasury stock, and then a little bit about the cumulative effects on net income, which we call comprehensive income, and a little bit about owner's equity in general. So I would take some time and review, especially the last problem we did, problem 28. Make sure you have a good handle on how owner's equity shows up on the balance sheet. This module will end our discussion of the balance sheet, and in the next couple of modules we'll be talking about the income statement and the cash flow statement. So make sure you understand the balance sheet before you continue on to the other statements.